Ladies and gentlemen, we're diving down into the Canadian housing market crash. We're going to fixate in Ontario, where we've seen corrections upwards of over 20%, a $200,000 price decrease. We're going to be getting into the rental explosion, this double-edged sword as value drops, yet rental prices go through the absolute roof. And then we're going to fixate more particularly on the interest rates that have to do with inflation, where the historical interest rates have come from, where it looks like we're headed to, and what that means for the prediction in the next 6 to 12 months of where the housing market is likely to go. Now, if that is a conversation you can appreciate being a fellow Canadian, in return, I simply ask that you hit that like button. So let's get right into this. Let's take a look at some of these stats. With first and foremost, guys, Toronto home sales plunged 41%. Prices dropped for the fourth month. Now, this is the thing that's scaring the crap out of people, because I still believe we have a supply and demand problem. But while the market gets shocked, while all of this value creation evaporates, people are just sitting on their hands. So we've almost seen a full 50% dry up in volume of sales. And what is that leading to? Well, obviously a buyer's market. This is a market where if you have the liquidity, if you have the cash, this is where you really want to start buying, because I still think the market will inevitably come back, maybe not to all-time highs right away, but this is going to cool off, which we'll talk about in the predictions. Now, year over year, when you look at this, it probably doesn't look that bad, right? Like the average home prices in Ontario have increased by 9% in a year to $881,000. The Greater Toronto Area home prices increased by 5%. The City of Toronto home prices increased 7%. So it doesn't really give you the full broad picture. This is what realtors usually like to throw in your face, saying, oh, it's really not that bad. But again, we are in a true crash. To see prices go from upwards of over $1 million to the 800K range in just a few months, over 20%, by definition, a crash. I mean, month over month, we're seeing a 6% correction. And just kind of reading the highlighted post here for June 2022, the average price of a home in Ontario increased 3% year over year to $881,000. Similar to other Canadian housing markets, the average Ontario home price has been slipping over recent months during a time of rising interest rates and slowing demand. June 2022's average home price was $881K, is a 6% drop compared to last month's average home price of $940,000. Average sold prices in Ontario's housing markets peaked in February of 2022, when the average sold price reached just over $1 million, almost $1.1 million in the province. That was the first and second to last time that Ontario's housing market ever saw its average price above the $1 million mark. This ended in March 2022, when the average price fell back below $1 million. So that's where housing sits. But from a rental perspective, this is just where things get kind of wonky, right? Now, Urban Nation said that the markets strengthened considerably in the second quarter due to the re-acceleration in population growth, a near record low unemployment, and the reduction in purchasing power as interest rates rise. Many of the US banks, Canadian banks, have been touting that the consumer is relatively strong, right? The average per square foot condo rent price rose 5.9% quarter over quarter to a new high of $3.57, with the annual rent growth reaching a record pace of about 16.7%. Usually, most people that buy rental units, they kind of do these cap rates where you want to make 5-6% after all the expenses, your property taxes, your interest rates, your mortgages get paid, right? That doesn't exist in Toronto specifically. Nobody is making money with minimum down payments and rental units in Toronto anywhere. But taking a look, that could start becoming a reality if the market keeps moving in these trends. And taking a look at Toronto, guys, from a month over month basis, rents are up 2.77%, year over year up 18%. That is a one bedroom. Two bedrooms are seeing the biggest increase. I mean, from $3,115 being the average rental price per month. That's month over month up 3.76%, and year over year up 23.37%. If you want to find cheap rental units, if you're looking to rent, I would highly fixate coming into this data and kind of just skimming through some of the areas where we're seeing cheaper rent, such places as Oshawa. Pickering saw only a pretty big month over month increase of 7.34%, but year over year is down 19% for a single bed and bath. Two bed, two bath, $2,300 a month average. You know, it's kind of crazy to see the discrepancy between one bed, one bath to two bed, two bath average, considering most of the prices in all these areas are going up. But you kind of want to go to where all these people, you know, the population growth, all of these foreign people coming into the country, everyone's fixated to moving to Toronto. So if you're more lenient, you can drive, you know, you have kind of an unlocalized job where you can work from home. I highly recommend finding a much cheaper place to rent based off the current statistics here. But Toronto, man, who baby, it's always funny that they're like the rental prices are locked. They can only go up 2% year over year. That's if you're already leased. But a lot of these people just push their tenants out, say, we're going to find new tenants, because then you can get market demand and it's not fixated on what the government's going to limit you to rent that place for. But taking a look, guys, let's talk about interest rates real briefly here. For the first time, materially, interest rates are higher than they have been basically since the 2008 financial crisis. This to me is very healthy for the market. Things have gotten overextended. This is wiping out some of the crypto guys, anybody that was over leveraged in real estate, which there were many people are, which is why we're seeing so many problems and people walking away from deals, people that got involved in real estate over the last 3 months. I made a video showing somebody that had a closed contract that is likely going to lose their deposit. I mean, they're going to probably get sued. Go check that video out. It's on my channel. I'll leave the link to that in the description below. It's like a real-time reaction of people getting royally screwed. And I think that's a common story these days. So let's just take a quick listen here to BNN, somebody talking about the interest rates and kind of what they're thinking. And then we're going to talk about the future of the housing market and what I personally see happening.
This decision today, do you think they can be successful in bringing down inflation to normal levels?
I think they can be successful. I think the question is at what cost? And I'll leave that to others to quantify the probabilities of a recession. But what I can say is that from what I heard, it sounded a whole lot like the Bank of Canada governor was willing to engineer a recession if that's what was necessary to bring down inflation.
And just look, well, it sounds like you don't want to make a prediction on whether we see a recession, whether we're already in a recession, but just in terms of what's going to be the nuanced difference on how sizable a slowdown in growth we see. People talking about soft landings and then talking about mild recessions. And then obviously, I think a lot of people, just given the environment right now, thinking of the Great Recession, thinking of the financial crisis. And in that case, you're talking about a length that goes beyond the average downturn that we see. What do you think ultimately is going to determine the path that we're on?
I think a monetary policy induced recession, so long as it doesn't come with some unforeseen shocks, say, for example, in the financial system, would be relatively modest and likely reversible, because you can always dial back the number of rate hikes. But more and more, it seems like we are taking the steps towards that type of slowdown in the economy. At first, we had the Bank of Canada coming out large with stimulus, and probably too large with regards to its quantitative easing program. Then rates were left too low for too long. Now what we're hearing is we're at 2.5% on the overnight rate, and we're going to need to go higher. The question is whether this is another case of the Bank of Canada being behind the curve, because we are starting to see already some signs of slowdown. I think you alluded to the job losses, the slowdown in the housing market, and some cracks forming in consumer spending. I wonder whether the Bank of Canada is going to be slow to recognize how much impact it's actually having on the Canadian economy.
So let me put this in perspective here, guys, on how the Canadian Treasury, the Canadian Bank, the U.S. Federal Reserve work. They don't have a lot of tools, right? Their primary job is to keep employment high and keep inflation low. And the only thing they can really do to do that is print money or raise interest rates and obviously pull money back off the table. And what's going to happen, because inflation is so strong, they don't have a choice but to raise interest rates, which again, I think is largely healthy. And coming into the next 6 to 12 months, for as long as inflation stays high, they're going to keep raising the interest rates. But as soon as that starts to hinder jobs, they're kind of walking a tightrope of how much they're going to continue to raise interest rates as jobs continue to get impacted by obviously liquidity drying up, asset values dropping, people doing layoffs, which we're probably going to see a material impact in the coming quarter. So that's where we're going to start seeing things get very fascinating, because obviously inflation will start to peak, which I think it already has. As soon as that tampers off, it's going to change the way the bank looks at their interest rate hikes. And then obviously if the job markets get hindered, they're really going to take a double look at how much they're raising that interest. And I feel like we're going to start seeing a leveling off probably in the next, I would say, 3 to 6 months. And then in the next 6 to 12 months, that's when the real estate market, that's when assets and everything will start seeing a nominalization and perhaps even starting to see a turnaround, because that's when investors and, homeowners, people that want to live with their families, will start being more intrigued to buy, because they know the interest rates aren't going to go higher. They know that we're not going to see these crazy price swings anymore. And that's when things will nominalize, because there is still a housing problem, I think, in the Western world when we talk about supply and demand, right? But it doesn't matter how much supply exists on the market. If the demand doesn't doesn't come up because people just aren't willing to take the risk, then it won't matter. Housing will continue to correct, right? So that's kind of the moment that we're in right now. But I feel like we're in the midst of this, the worst of it. And we're going to start coming out on the other side as all of that exuberated wealth and money printing kind of alleviates with the interest rates rising. So I would just be very patient. If you're looking to buy a house, I honestly think we're in a buyer's market right now. We can tell that there's crazy demand because all those people that aren't buying now are moving into the rental market. So it's kind of one of these catch-22 situations where, again, you have to be in a good situation to have liquidity to buy. But I honestly think starting to look at homes, negotiate pricing with some people that maybe are more pressured to sell because they had a buyer just walk away. The prices have dropped. You know, some people are looking to get into this for their retirement, and things are getting a lot rockier. So if you're buying, congrats to you. This is the time to get into that. If you're renting, you got to be very careful what you're doing there and just be patient. 6 to 12 months from now, this story will have alleviated, interest rates will have normalized, and the markets will probably return back to a healthier place. But at this point, I want to pass the question off to you. What do you guys think about the entire Canadian housing market? I'd love to hear it in that comment section below, but stay cool, stay awesome, and as always, I look forward to catching you in the next one.